Good afternoon and welcome to another VSA Capital Technology and Transitional Energy podcast with myself, Phil Smith, as analyst and host. And this week, instead of my normal partner, Andrew Monk, who's away on business, I've got David Scriven, our head of sales, here to chat with you and about the markets.
Phil, it's a pleasure to be with you and looking forward to going through tech and transitional energy podcasts. So do you want me to kick off with the US?
That will be fantastic.
Well, I don't know about you, but I've been a little bit anxious about Windows EOL end of life, which was on the 14th of October. Because I was on 10, so I had to migrate to 11, and I hope everybody else has done it. But within that context, PC unit shipments, that's being tracked by IDC, have increased 10% in the third quarter of the year. That's the third consecutive quarter of sequential growth ahead of typical seasonality. Now, this trend was driven by Windows EOL and refresh of the aging installed base. Now, North America was a bit impacted by the US tariff dynamics and only grew 1% year over year. But Asia Pac had double-digit growth and driven by Win 10, EOL, and an education project in Japan. So when one looks at this, outside of the seasonal trends, does this pose for us? Does Windows 10 EOL deadline create a concern about the sustainability of growth into 2026? Well, what I did find interesting was just a few days back, Michael Dell recently sold 6.2 million shares, raising over 1 billion. Now, his share price has gone from 68 in April to 151 current. So, wow, interesting dynamics. But as you know, I love going through the ETFs and the indexes in technology to discuss thoughts on the podcast. What I'm going to do is I'm going to start off with the ETFs and kind of merge the SOX with the AI ETF. So kicking off in clean energy, it's had a strong rally over the last 6 months, going from 7.94 pence to 9.9. Now, the key drivers and names that we have talked about before, so I'm not going to dwell too much here at all on this, is the power systems providers like GE Verona and Siemens Energy. And they're just shy of their 5-year highs. Now, breaking down the composites, in solar, everybody must be conscious that silver prices have been rising and crossed $50. And the PV industry is being prompted into thrifting or reducing silver content in cells and modules. The industry has to be careful not to reduce quality, and interest in alternative metallization is growing. Screen printable copper and copper containing pastes are the most promising method to significantly cut silver use, according to researchers at Fraunhofer ISE in Germany. Now, that's the general outlook, but in more specific names, if one focuses on the US, the First Solar share price has had a very strong run, and that could reflect solid bookings momentum and the expectation of increased finishing capacity in the US in 2026. And the significance of that is that it would reduce tariff exposure and unlock manufacturing credits. So where I'm going with this is there could be other factors that are driving the solar names up, whilst in the background there is that, I wonder how the impact will be on the industry through a higher silver price. Now, moving into wind, we talked about this last time we were on the podcast, and Orsted was having a potentially tough time. Now, what they have done is they've been able to conclude the rights issue, which was pending, and they've also cut 25% of their workforce. But still, the stock is a bit range bound in the low end of the trading range for the year. Now, perhaps the key catalyst for the share price is the outcome from the court case linked to the halted Revolution Wind project in the US. Now, in battery supply chain, The ETF is at a new 5-year high, and EOS, the energy storage provider, has seen its share price double over the last 6 months. Likewise, AMG Critical Metals, and they have additionally been helped by the signing of an MOU with Beijing eSpring Technology for the supply of battery-grade lithium hydroxide. And then before we move on to, the SOX, the cybersecurity ETF, that's been moving sideways over the last several months. Now, contributors within that index have been BRoadcom and Cloudflare, who are collaborating with leading payments companies to secure and enable agnetic commerce. Akamai has been a detractor as the secular decline in content delivery network, CDN segment, is offset by new security products. And then I'm going to finish up embracing both the SOX and the AI ETF and draw your thoughts into that, Phil. But if you kindly let me start off, I will ask you to help me out. So the semiconductor industry expectations for Q3 are basically in line with a constructive outlook and possible analyst upside revisions for Q4. Industry revenue growth is expected to be about 15 to 20%. Now, underpinning this is AI demand and pull-through across the value chain and cyclical recovery in non-AI. This is supported by AI mega deals announced by OpenAI to increase compute capacity, forecasts that the hyperscalers are going to increase capex growth higher than initial forecasts, i.e. 55% year over year versus 40% only 3 months ago, and user growth through chat GPT. In non-AI, cyclical recovery in industrial and seasonal trends in smartphone are encouraging. Now, supporting that notion of Q3 earnings, we've had Taiwan Semiconductor reporting yesterday. That Q3 net profit was 452 billion new Taiwan dollars, NTB, versus the street at 410 billion. Q4 revenue growth guidance is expected to be mid 30% versus originally 30%. And the company's conviction in the AI megatrends is strengthening, according to the CEO. Additionally, in reporting companies, ASML reported bookings for the third quarter that beat estimates. Bookings were euro 5.4 billion versus the street at 4.8. Gross margin and net income were also ahead of estimates. And ASML expects a very strong Q4 of 9.2 billion to 9.8 billion euros versus that Q3 of 7.5. Now, you may have in the back of your mind, well, what about China? Now, in 2026, the company sees significant decline in net sales to China, but total net sales are not expected to be below 2025. The AI boom in the coming years is expected to drive annual revenues to 60 billion in 2030 versus 28 billion last year. Now, yesterday, the stock initially was up about 3%. And then tying things into the AI ETF. Now, within the top sort of 10 names within that ETF, I've already touched on Taiwan Semi and ASML, but I'm just going to quickly mention Nebius and AMD and then explore our thoughts on semis. So Nebius, the AI infrastructure and service provider's share price, has moved from 22 to 128 over the last 6 months. Microsoft has inked more than a 33 billion in commitments to neo-cloud providers like Nebius to cope with the storage of AI data center capacity and free up its own server farms to provide lucrative AI services to customers. And AMD and Oracle announced a major expansion of their long-standing collaboration to help customers significantly scale AI capabilities. Oracle Cloud Infrastructure will become a launch partner for the first publicly available AI supercluster powered by AMD Instinct 4150 series GPUs. This follows the deal with OpenAI. The shares are just shy of their 5-year high, having more than doubled since March of this year. So, Phil, I mean, a lot of that background drop sounds very, very positive. And as you pointed out, there's a Reuters article that came out just recently, which basically said investors on guard for risks that could derail the AI gravy train. So I was going to sort of open it up and say, look, 50%, according to Citi, of the S&P 500, circa 57 trillion market cap, has high or medium exposure to AI. So there's all the excitement, but also, should we be careful?
Gosh, that's a big question. Thank you very much for that one, David. Should we be careful? Well, you've always got to be mindful of valuation metrics and getting ahead of themselves in terms of growth. But right now, it's the scale of capital expenditure that we're seeing these technology providers with very, very strong balance sheets, undertaking. And I think until that capex cycle starts to slow, or there's something triggers it to slow, i.e., weakening end customer demand in terms of AI technology developments, then it's difficult, challenging to see a trigger to the markets actually, falling significantly. Clearly, when DeepSeek came out, there was that sent a bit of alarm bells through the market from external competition. But just right now, we are seeing these heavy capital expenditure commitments. So, I'm looking forward to seeing the quarterly statements from the results period that's coming up, to see what the outlook for capex is, in particular into new year. I mean, what's also interesting is sort of other people getting in on the game in terms of committing capital. I saw that JP Morgan Chase announced a decade-long $1.5 trillion investment initiative this week to finance and invest in industries across the US. This is in terms of national security, defense, energy, and advancing manufacturing, according to Reuters. So, and AI comes into that as well. I mean, it's starting to become quite critical at the national level as well, the investment. So, yes, the big question is around it continuing, David, to be honest.
It's fascinating. And last weekend, all the family met up and we were in Oxford, and Larry Ellison has invested 250 million in the Oxford Science Park. And I believe he's going to add to it probably in the region of another 500 million. So it's absolutely fascinating.
Yeah, he is. Look, the big question about it all, about AI, is going to be the returns on all of that investment. Can companies at the end of the day usefully use it and profit from doing so, or increase their efficiency? And the other thing is on the capital investment, what incremental gain comes from it ultimately, or is it, does it become just more of the same? So there's big questions around that yet, but we've not had enough time into this cycle to see where we get to. But as you and I know, being in the markets for a long time, when you see charts going almost vertically upwards, you start to get concerned on the valuations ultimately.
Indeed, sir. And what have you got for us in the UK?
Right, okay, well, let's get on to news closer to home. There haven't been too many announcements and results this week, but there's a couple that caught my eyes. First one was Synectics, the ticker's SNX, and the shares are up by 10% in the last year. It's an interesting company. They have, this is software and vision systems all around security. They had a trading update for the full year, and they're expected to deliver revenues of £67 million versus £55.8 million last year, and profit before tax of 5.7 versus 4.7 million. They've seen increasing repeated orders from longer-term customers. They delivered a gaming contract in Southeast Asia for the period, but the company is quite interesting at the moment because it's diversifying in terms of its end markets, particularly focusing on energy. and it's investing to do that for its security and vision systems. And they've announced, today, they've got good order books, but they've recently announced a contract in renewables sector, and this is valued at £1.2 million for advanced surveillance solutions, the carbon capture transport plant. This is part of a hydrogen project in the northwest of England, and they're going to be delivering cameras and software systems for that. So that was Synectics, making good progress. One that we've talked about a lot in our Technology Transitional Energy podcast is Oxford Instruments. The ticket is OXIG. Market cap is £1 billion. They've got a half-year trading update to September. And the shares fell on the day. Now, what do? They provide, this is described products and systems for industry and research. This is all about advanced instrumentation technologies for furthering scientific discovery, but also making advanced technology products. They go to market segments, including materials analysis, semiconductors, and healthcare. They've got two key divisions, imaging and analysis, and that focuses on microscopy and analytical instruments. And then they've got advanced technologies. And these are involved in compound semiconductor fabrication, developing superconducting magnets, and they have X-rays and I think electron microscopes technologies. Anyway, two divisions there. I'm looking at the trading statement. On the imaging analysis arm, they have said they have seen very tough marketing conditions, particularly as the US tariff policy evolved, quote, and they said that order intake was impacted by some academic and commercial customers delaying purchases, shifts in the global trading environment. But all in all, it seemed to be reasonably difficult for them, and said that order intake fell by around 6% in the first half. However, on the Advanced Technologies division, they seem to be doing very well. In the compound semiconductor market in particular, they've seen very strong order growth. And they've reported that they had 25% growth in first half orders and a full order book for half two. Also in augmented reality, they've seen reasonable demand there. But all in all, given the mix, they reckon that the revenue for the first half is expected to have fallen by 10% year on year from £204.2 million. Second half revenue expected to be marginally up versus the second half of 24, and they're expecting full year revenue adjusted profit margin to be similar to the prior year. So, as I say, the market reacted a bit negatively to that with Oxford Instruments. The company sold Active Ops. The ticker is AOM, 153 million market cap. Shares are up by 76% this year. They had a trading update for the 6 months ended the 30th of September. Really interesting company, this. This is software that serves the banking and insurance industries, and they call it decision intelligence software. But it's all about improving operational controls, and increasing productivity. So getting better returns out of the efforts being put in by their employees, but also increasing customer satisfaction. They've got clients including National Bank, AIB, Nedbank, Nationwide, users across 40 countries, so an international business. And they're expecting to report overall revenue growth of approximately 45% or 50% on a constant currency basis to £20.8 million in the first half ending September. They had an acquisition during the period. They're saying with the solid revenue performance, we're expecting to deliver double-digit adjusted EBITDA growth, an increase in profit before tax. And then just getting onto the acquisition, they acquired a company called Enlighten, but they said they're well capitalised, end cash of £13.3 million after £5.5 million was spent on Enlighten. So, yeah, that's Active Ops. Again, doing very well. Now, sticking with IT, and this is in IT services, software security, AI, cloud services, Bytes Technology. One of our bigger IT services providers, they had interims to August end. Now, the company, I think, had a profits from recollection of the profits warning in July, where they said that trading had been impacted for the first months of the year by challenging macroeconomic environment. They've just reported, this is interims, and they said that their gross revenues are up by 9.1%, 8.9% growth in the provision of software, 15.1% in services. And the actual revenue that drops through that, remember they may be reselling services, was a rise of 2.5% revenue to £108.1 million. Gross profit increased slightly to 82.4, but the operating profit dropped by 7% to £33.1 million. And what's quite interesting is when they're looking at their costs, they said higher headcount, salary, and national insurance costs were impacting the operating profit negatively. But the company's got very strong cash reserves of £82.3 million. They've announced a £25 million share repurchase program and is confident in delivering its full year. So that was Bytes Technology. Now, Volex, which was a recommendation of the year, I think a couple of years ago from us. Volex is 683 million market cap. VLX is the ticker. The shares are up 38% year to date, and they had a trading update. Now, Volex has manufacturing plants internationally. What do they do? This is all about connectivity solutions. So this is about highly specialized cables and connectors that can carry high power or carry data at very, very high rates. So kind of looking at the end markets. For Volex, I mean, in terms of revenue, it's expecting to exceed £575 million, organic growth of at least 11%, operating margins to remain within the upper half of the board's range of 9 to 10%. But again, getting back to these end markets, they said electrical vehicles grew very strongly year on year. Diverse range of products. Medical demand was subdued. Customers, this is assessing the implications of lower spend in healthcare. I mean, this is something that we've talked about, David, in the podcast before, and the impact that that's having. Consumer electricals revenue similar to H2, but down an organic basis, but off-highway delivering strong growth. This is in consumer electricals. But getting back to where we started, and AI, remember that they do cabling and connectors to carry data, and data at extremely high rates, and data within data centers. So the data center market is a big one for them, and they said that their complex industrial technology business, quote, grew significantly, with data center demand showing a very strong increase relative to the first half. So a very positive trading statement from Volex there to end on, and of course the subject of data centers. So there you go, David.
That sounds very good for Volex, particularly that segment. I also wonder from your comment on Oxford Instruments how much a drag will be from tariffs, because obviously the market would be more comfortable when they feel that drag goes away from certain companies, and it'd be something to watch out for, and all the results that might be impacted by them.
Well, yeah, and you've got to remember that Oxford Instruments has been around for many, many years, and I'm sure I had to weather a few storms in the past, and I know from the sort of instrumentation markets, it's a very, very well established brand, so it is one to see how things progress. Would be my view on that. But there we are. So, David, listen, it's all been very exciting. We're looking forward to US results. Started to come through later on in the month, and we can certainly see where we stand there in terms of AI and AI investments. So I'd like to thank you very much for joining, David, this week. So thank you.
Thank you.
And as always, if our listeners have any suggestions, companies for us to talk about, things that we've missed, observations or whatever, then don't fail to get in touch with either Andrew or myself, and we look forward to chatting again on the VSA Capital Technology and Transitional Energy podcast again next week.
Many thanks.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.